This is Nick Rach with the Earnings Scout, and today I'm going to review the earnings estimate revision trends for Nimble Storage, determine if this is a stock that has been absolutely obliterated over the past year. Stock's down about 63% over the past year. Is this something at this point, do you want to short it more, which we were saying to sell the stock a year ago at this time? Or is it time to finally buy the stock? Is it cheap enough now that it's dropped 63% in value? So to answer that question, we're going to answer it real quick. We have an indicator score of 75 out of a possible best. So if you just wanted to go real quick, at a 75 indicator score, we're telling you to hold the stock. Why? Because we think the worst of the revisions occurred right here back in November 2015. We'll explain why our model wants to not sell this stock anymore just based on that, where the worst of the revisions has already occurred. But let's take a look and see what we're measuring here. We already said the red line is measuring the price. The stock's down 63%. These blue lines on the screen here are measuring what we call proprietary earnings score for Nimble Storage. And what it's doing is it's measuring the overall rates of change to Nimble's earnings expectations out into the future, 6 months to 2 years. We're rolling these out over periods and then measuring them across time. When I draw on the line here, what we call a zero line, basically what this means, when the earnings score is below zero, that means on an absolute basis, Nimble Storage estimates are falling, going down. And you can see over the past year here, Nimble Storage's earnings estimates have been going down almost the entire time. The score itself tells you the magnitude by which those estimates are going down. So I want to circle this period right here, highlight it again. You can see it flashing on the screen. That is when Nimble Storage last reported earnings on August 23rd, 2016. To show you how we're calculating the score in a very rudimentary fashion, we're going to show you a couple periods here to show you how we're getting this score that's just slightly below zero. So when Nimble reports on August 23rd, the very next day, the earnings estimates for its October 2016 quarter. When Nimble reported on August 23rd, it was reporting a July quarter end. So its Q1 estimate changed to a loss of 47 cents a share. 90 days prior to that, it was minus 45. So the estimates were falling at a rate of minus 4.44% for the Q1 estimates over the 90 days. If that was the only period we were looking at here, the earnings score would be minus 4.44. We're looking at multiple periods and multiple quarters, multiple years of estimates here. So for the sake of simplicity, we just wanted to show you that to try to give you a gist of how we're calculating this score, so you can understand the logic of a company where we see losses for the company and estimates still falling, but yet we're not telling you to short the stock. There's the fiscal year 17 estimates. You can see they were coming down at a rate of 2.19%. So when we look at it all said and done, this second quarter earnings season will classify it as that when it reports its July quarter end. After Nimble reported, overall earnings expectations in our proprietary blend were falling at a rate of 2.66%. If we look back in last year's third quarter earnings season, when Nimble reported, it would have been in the month of November. After it reported, its earnings expectations were falling at a rate of 48.67%. Now, we said this is when the worst of the revisions were occurring in terms of magnitude downward. Then you have fourth quarter earnings season. Nimble's earnings estimates are falling rate of 25%. And then in first quarter earnings season, they're falling a rate of 9.17%. So you can see here lower lows in peak earnings season. So what we always say to clients when they're looking at this, the earnings estimate revisions can be lumpy. Most of the revisions for Nimble will come in after it reports earnings. You know, what we're going to see is we're going to measure this slope of this line. Because the data is never linear, what we're going to do is measure the increasing slope, and we're going to say that Nimble's earnings estimates have been improving over the past year. And we want to buy improving earnings at a cheaper price. That's why with the stock down, we're saying to buy the stock. And this is why we can like a stock where earnings estimates are still falling. The street hasn't rewarded it at this point and haven't taken advantage of that. And that's a stock that we'd want to buy. Now, in the case of this correlation for this stock, what we're measuring here, the stock was falling when the rates of change to earnings were falling early in the year. It really hasn't picked up on the divergence that's occurred really since January for the stock. In other words, the improving earnings haven't been priced in. The other thing on the screen here is the volatility we rank. It's a part of our indicator score, as well as the correlation and the earnings trend itself is the variance of all those earnings scores. So we're measuring the volatility. In this case, Nimble Storage, at the worst, the estimates over this past year were falling by 49%. And at their best, they're flat. So that's the range of which they're going. We rank that across 4,500 other companies in our database to actually determine that the worst is over. How do we see that, and how do we want to buy Nimble Storage? We were actually saying to short the stock and sell the stock for Nimble back in 2014 and 15. And as we look at this, why were we doing that? Because the estimates are falling at increasing rates. All the way down to a third quarter 15 earnings season last November, when the estimates were falling at a rate, at their worst, 48.67%. Now, when the worst of the revisions occur, now you can see that the earnings trends are improving. The price hasn't really reflected all of that. This is why we're saying don't short Nimble stock anymore. The worst of the revisions have been already accounted for, and the price has not fully reflected any improvement yet. So don't short this stock anymore. And if you look how we've recommended this stock over the past year, we try to make this easy for you too. You could look at the raw earnings scores himself and try to interpret, or we'll just tell you based on our indicator scores of how we rank Nimble across our 4,500 other companies. A year ago at this time, when the stock was near 24, we're telling you to short the stock or don't own the stock if you're long only. And then you can notice our first buy signal came in on May 27th, 2016. Why? Because in November, when the worst of revisions were over, we had a couple quarters of seeing that improvement. We could pick up on that, see the price didn't fully reflect that improvement, and we're telling you to buy the stock. And it's been in this range for a while. We still think this is a good stock. Even though it's a 75, we're not saying quite buy. It's a 75 out of 100. You don't want to short it anymore because all of the bad news has been, in our opinion, priced in, and this company has an increased margin of safety at this point. So if you like what you see and you want to learn more about Nimble or any other companies we have across our database, we do these not only for the 4,500 other companies, we also do this for every sector and industry. We try to take the guessing out of the game by showing you facts on earnings and present it in a way you're not going to get anywhere else. And again, if we can reduce some of the randomness in the market for you and help you make a more informed decision, we're going to really help you increase your alpha. So you can reach out to our sales and marketing team here on the screen or contact us at sales@earningsscout.com. And again, thanks for listening and good luck investing. Thank you.